We're all taught that some financial rules are just universal. They apply everywhere. But what if they're not? We're going to dive into a fascinating study from Sri Lanka that totally challenges some of the biggest assumptions we have about how stock markets are supposed to work. And trust me, the results are pretty surprising.
So let's just start with a big question. What if the core principles of the stock market aren't universal laws, but are actually more like local customs? Things that totally change from one country to another. That's the rabbit hole we're going down today.
Okay, so before we can really appreciate how the rules get broken, we first need to get on the same page about the standard playbook. Let's do a quick run-through of 2 core concepts that you'd learn in any Finance 101 class.
First up, market liquidity. All this really means is how quickly you can sell something for cash without tanking its price. So think about it like this. Selling the latest smartphone? Super easy. There are buyers everywhere. That's a highly liquid asset. But what about selling, say, a super rare, one-of-a-kind collectible? Yeah, that could take a while. That's highly illiquid.
Now, standard financial theory says that if you're going to take on the risk of holding something that's hard to sell, you should get paid extra for it, right? You'd expect a higher potential return for that hassle. This is what we call the illiquidity premium. The basic logic is more risk should equal more reward. Simple enough.
The second big idea is investor sentiment. This is really just the market's collective mood. Are investors feeling optimistic and ready to buy everything? Or are they scared and cautious? It's basically the financial world's version of buzz or hype.
And here's where it gets interesting. A really famous theory from Baker and Stein back in 2004 argues that a frenzy of trading activity, which is a sign of super high sentiment, is usually a huge red flag. It suggests investors are getting way too confident, maybe even irrational, and it often predicts that future returns are about to drop. Think of it like a party that's getting way too loud right before the cops show up.
All right, so we've got our 2 textbook rules. 1, higher risk should mean higher returns. And 2, intense hype often leads to a downturn. So let's see what happened when researchers put these ideas to the test in the real world, specifically at the Colombo Stock Exchange in Sri Lanka.
And this, my friends, is where the story gets really good, because the data that came out of Sri Lanka seems to completely contradict those theories we just talked about.
Just look at this. The standard theory says that as illiquidity risk goes up, returns should go up to compensate. But in Sri Lanka, the data showed the exact opposite, a significant negative relationship. The wild conclusion was that taking on more risk was actually linked to getting lower returns.
This brings us to our first huge puzzle. Why on earth would any investor willingly accept lower returns for taking on the bigger risk of holding a stock that's hard to sell? It completely flips the whole logic of risk and reward right on its head.
But wait, the surprises did not stop there. Let's move on to our second mystery. This one all about that investor mood, that hype we were just talking about.
Okay, so remember how a ton of trading volume was supposed to be a red flag? Well, in Sri Lanka, it was more like a green light. The data showed a positive link. That means that more trading, more hype, was actually connected to higher future returns.
And the researchers themselves didn't pull any punches on this. They state it directly. Their results just do not agree with that classic Baker and Stein theory. This wasn't some tiny little difference. This was a complete 180.
And you can see here the contradiction couldn't be more stark. While the theory warns that a trading frenzy leads to lower returns, the reality in Sri Lanka was the opposite. It was a signal of higher returns to come. In this market, the hype was actually a good thing.
So what in the world is going on here? Are the fundamental laws of finance just broken? Well, not exactly. To solve these puzzles, we have to understand what makes a frontier market like Sri Lanka so different.
See, frontier markets kind of operate with a different DNA. Think about it. There's less transparency, way fewer companies to invest in, and a much bigger chance for investors to just follow the crowd. In an environment like this, investor strategies tend to be simpler, like, hey, that stock is popular, let's just buy that. These factors don't just tweak behavior, they can rewrite the rules entirely.
So how does this actually work? Well, in a market like this, high trading volume isn't really a sign of craziness. It's more like free advertising. It boosts a stock's visibility, which makes more investors notice it. That increased attention creates more demand, which then, you guessed it, drives the price up. It becomes a self-fulfilling prophecy where the hype itself leads to real gains.
And what about that first puzzle, the liquidity one?
Well, the studies suggest that in a market with fewer investment options, just being able to spread your money around to diversify at all can be way more important than worrying about how liquid each individual stock is. The priorities are just completely different.
So let's just recap the two big reversals we saw. Standard theory predicts a positive liquidity premium and a negative sentiment effect. What did we find in Sri Lanka's market? The exact opposite, a negative liquidity premium and a positive sentiment effect. It's a perfect mirror image of what the textbooks tell us to expect.
Okay, so what does all of this mean for you and me? The ultimate lesson from this whole deep dive is actually incredibly simple, but also really powerful. Context is everything.
So here's what to remember. First, a lot of financial rules are really just theories based on what happens in big, developed markets like the US. They aren't universal laws of nature. Second, investor behavior can be radically different depending on the local market. And finally, a signal like high trading volume can mean one thing in New York and the complete opposite in Colombo.
Which leaves us with one last thought to chew on. If foundational rules about liquidity and sentiment can bend and even completely break from one country to another, what other financial truths that we all take for granted might be worth taking a second look at?